Okay, so if you're running a business in India, you're dealing with GST. It's just a fact of life. And that means you've almost certainly had to wrap your head around input tax credit, or ITC. Now, this is a system that can save you a ton of money. But man, it can also be a massive headache. So today, we're going to demystify the whole thing, from the absolute basics all the way to the latest court rulings.
Think about it. Every single time you buy something for your business, whether it's raw materials, office supplies, a new piece of machinery, you're paying GST on it. So, the big question is, how do you get that tax money back into your pocket? Well, that's exactly what we're here to figure out.
All right, here's the roadmap for today. We're going to start with the absolute fundamentals. What even is input tax credit? Then we'll dive into the nitty-gritty, the core rules you have to follow, and that super important deadline in Section 16.4. After that, we'll talk about some recent changes that are a huge relief for a lot of businesses, see what the courts have to say about all this, and then wrap up with a solid strategy you can use. Let's jump in.
Right, Section 1. Let's start from the very beginning and build a solid foundation. What are we actually talking about when we say input tax credit? You can think of it as a professional rebate system from the government. So when you sell your product or service, you collect GST from your customer, right? That money is meant for the government. But here's the magic trick. You get to subtract the GST you've already paid on all your business expenses. This whole mechanism prevents the cascading effect of tax on tax, and it's basically the heart of the entire GST system. Now, the law gets a little specific here, and it's an important distinction. We have inputs. That's your day-to-day stuff, like raw materials or packaging. Then we have capital goods. These are the big-ticket items that you capitalize in your accounting books, like machinery or equipment. It seems simple, but knowing the difference is absolutely the first step to claiming your credit the right way.
Okay, so you get the concept. But how do you actually claim it? Well, it's not a free-for-all, that's for sure. There's a really clear set of rules you have to follow, and they're laid out in Section 16, Subsection 2 of the CGST Act. Honestly, the best way to think about it is as your non-negotiable eligibility checklist.
And here is that checklist. 1, you gotta have the paperwork, a valid tax invoice. 2, you have to have actually received the goods or services. You can't claim it beforehand. 3, and this one is a really big deal. Your supplier has to have actually paid the tax they collected from you over to the government. And finally, 4, you need to have filed your own GST return. You have to tick all 4 of these boxes. No shortcuts. Now, I want you to burn a number into your brain. It's a really, really important one in the world of ITC, 180. You have 180 days, about 6 months, from the invoice date to pay your supplier. If you've already claimed the ITC on that purchase, but you fail to pay them within that window, you have to give that credit back to the government. Oh, and you'll probably have to pay interest on it too. It's a serious rule that really underscores how critical cash flow management is under GST. So, you've followed the checklist, you've paid your supplier on time, but there's one more major hurdle. It is a hard, strict deadline that acts like a gatekeeper for your claims, and it's found in Section 16, Subsection 4. Here's how it works. For any invoice you receive in a given financial year, you have until November 30th of the following financial year to claim your ITC. So for example, for any invoice from the 2022-23 financial year, your final drop-dead date to claim that credit was November 30th, 2023. It's a clear cutoff. And I really can't stress this enough. When I say it's a hard deadline, I mean it's set in stone. If you miss it by even one day, that credit is just gone. Poof. You can't get it back. There are no extensions, no exceptions. The system is designed this way on purpose, and this deadline is its sharpest edge. But hang on. What about all those businesses that were just figuring things out in the chaotic early days of GST? Was all their missed credit lost forever? Well, I've got some good news. The Finance Act of 2024 has basically thrown a lifeline to those businesses, creating a new way to unlock ITC that everyone thought was gone for good. This table lays out the changes beautifully. You can see the biggest one right at the top. The deadline has been retroactively extended for those first 4 tricky years of GST. There's also some great news for businesses that had their registration canceled and then restored, and for anyone who's pulled their hair out over reverse charge mechanism supplies, you know, where you, the buyer, have to pay the GST. Well, there's finally some much-needed clarity there. This is a massive deal for a lot of companies. Let's just zero in on these 2 for a second. That first one, Section 16.5, is a potential gold mine for businesses who were struggling to adapt back when GST first launched.
And the second one, Section 16.6, is a genuine lifeline for businesses that went through the whole cancellation and revocation process. These aren't just small tweaks, they're major legislative changes that could put real money back on your balance sheet.
Now, with a deadline as strict and unforgiving as this one, you just knew it was going to end up in court. So when businesses challenge the rule, what do the judges have to say? Let's take a look. The verdict from the courts has been loud and clear. The Patna High Court, in a major ruling, has confirmed that the government is perfectly within its rights to set a strict deadline for claiming ITC. It's constitutionally valid. End of story. And this quote from the ruling really says it all. Input tax credit is a benefit and not a statutory right. That's the key phrase right there. It means ITC isn't something you're automatically entitled to. It's a concession, a perk, offered by the government. And because it's a benefit, the government gets to set the conditions for receiving it, including, you guessed it, a deadline.
So what's the final takeaway from all the legal battles? It's this. That time limit is not a suggestion. It is mandatory, it is legal, and it must be followed. While the new amendments offer relief for past years, they don't change this fundamental principle going forward. You have to hit that deadline, period.
Okay, so what does all of this mean for you and your business in practical terms? How do you navigate this landscape without getting into trouble? Don't worry, we're going to lay out a clear compliance map for you right now. First things first, go back and look at your books for those early GST years, from 2017 to 2021. Thanks to the new rules, you might find you're owed some money. Second, if you've had claims disallowed in the past, now is the time to use the new process to get those rectified. Third, train your team. Make sure everyone who handles invoices understands these rules inside and out. Fourth, get your paperwork in order. Audits are a certainty, so you need a crystal clear documentation trail for every claim. And finally, be proactive. GST laws change, so you have to stay on top of the latest updates. So we've walked you through the rules, the recent changes, and the final word from the courts. You have the map. You know where the shortcuts are, and you know where the cliffs are. The only real question left is, are you ready for your next tax audit? Take a good, hard look at your processes. Are you leaving money on the table? Are you prepared to defend your claims? The clock is always ticking.